already 6:10 right now, so I just want to thank everyone for coming, taking some time out of their night to learn more about life insurance and long-term care, which is never a fun topic. It's in and of itself a scary topic, but we, of course, as financial planners, want to bring that information to everyone to educate, because there's a lot of misinformation out there as well. So, again, today's topic, navigating life insurance and long-term care. What do I actually need? So, wanted to introduce ourselves, of course. We are financial planners. My name is Brandon Chan. This is Alex Sierra. We're part of Sierra Investors, and we have over a couple decades worth of experience in financial planning itself. Before we do start, want to do a little housekeeping. To learn more about our services, everything like that, check out our website online. This is going to be toriandalex.ceterainvestors.com. From the website itself, you're able to schedule meetings. So if you have any further questions in regards to life insurance, long-term care, or any other topics that kind of pop up into your head, please schedule a meeting with us. We're here to answer your questions at the end of the day. Also, as many of you know, on a monthly basis, we have blog posts that are coming out, and that's where you get a lot of information, updated topics, things that are happening in the market, things that are happening with the government, everything like that. And then lastly, you're able to actually watch our videos that we post on a regular basis as well. And like I said, in regards to scheduling a meeting, there's a button, and I'll actually point it out right here, schedule a meeting button right here. And then from there, you'll hit our landing page where you can find your specific advisor that you want to speak with as well. Let's see. And this is the YouTube page, which is just Tori and Alex on YouTube. We post regularly, I would say, every month or so.
Maybe every 2 weeks.
Every 2 weeks?
Yeah.
So we're very active on there.
Yeah.
And then let's see. And just diving deeper into our YouTube, Alex, he focuses on generational wealth building, or right there. So in regards to that, you're going to find at least, 11 videos on the individual step-by-step guide to build generational wealth. And then on my side, over here, I actually focus on personal finance. So you're gonna find a lot of information on credit cards, debt, car loans, purchasing cars, everything like that, nitty-gritty things in regards to personal finance that is all-encompassing for everyday life right there.
And one of our goals is to get to 1,000 subscribers by the end of this year. We're currently a little over 500, but if you haven't already, subscribe and spread the word as well.
Okay, before we hop into the actual meat of the discussion of long-term care and life insurance, I want to go over the folder that's in front of everyone right here. So if you open it up, want to focus first on the left-hand side of the folder itself. The first one you're going to see is actually going to be a little introduction to the team right here. And from there, you know who's part of the team, as well as if you want to schedule a meeting, we do have a QR code for you to scan and find our exact calendars online. Behind that as well, you'll actually get a copy of the presentation for you all to take notes on, because we're going to be going over a lot of information right here. And as well, if you have questions, take note of them as well. So we'll schedule maybe or put aside like 10 minutes at the end of the presentation to go over all your questions, because there are going to be a lot of them. Now, on the right-hand side, we're actually going to go over this at the end. Alex is going to take some time to go over this. It's going to be in regards to Asset Map, as well as our trust services. And then lastly, in the little pocket on the right-hand side, you're going to see our business cards as well with our direct contact information. Great. Okay, so without further ado, let's get into the conversation of life insurance and long-term care. Now, this is going to be our agenda for tonight. Looking at how much life insurance do you need as an individual. We're going to be going over the types of life insurance that is. Next up, we're going to go over how much does long-term care cost, because that's going to be a big topic nowadays as the average American is getting older. Next up, we're going to be going over long-term care insurance 101. And then the last kind of pieces are going to be the application process, how to apply for either life insurance or long-term care and what to expect out of it. Now, before I kind of go over, everything right here, I just want to take some time to go over the importance of life insurance. And I have actually 2 stories in regards to why it is important to kind of show you each scenario and how it plays out. So For the first family we're going to be going over, they're actually clients of ours. I'm not going to disclose their names or anything like that, but want to go over their story. Married couple in their 50s and 60s. The husband unfortunately passed away in April 2020, which was the beginning of COVID. Unfortunately, this happened. He was one of the first people to pass away. It broke the family, essentially. It was very hard on the family itself. Now, the husband luckily had over $250,000 in life insurance, whether that be from the group term insurance from his employer or the private life insurance that he bought himself when he first started working with his financial planner. What that money did for the family essentially helped the wife, the surviving spouse, retire early, as well as left something for the kids right there. This allowed the family to not worry about the financial troubles when they're going through the emotional tolls of losing a loved one right there. And then from there, kind of fast forward to today, like I said, the surviving spouse, she's already retired, she's traveling the world, she's enjoying her life that she has left on this earth. Now for the kids, 2 adult kids, they're in their 30s right now. Just recently, the daughter actually bought her first home. Young 30s, great career, but that money that was left over from the life insurance policy allowed her to kind of get a jump start in her own financial planning and her own kind of life itself right there. So it was a great kind of thing that happened to them that, hey, dad left this kind of gift to us in the case that anything happened to him. And kind of, so they don't have to worry about all the emotional stress that goes with losing a loved one. That's the great part of it. However, let's look at kind of a different story in regards to another couple of our clients right here. Now, married couple, they only have one daughter, one child right there. Unfortunately, she just actually passed away recently right there. And then
Not the daughter.
No, I'm sorry.
Just the mother.
Not the daughter.
Yeah.
The mother, my apologies. The mother passed away just recently. And then from there, she did not actually have any life insurance, or there wasn't enough from the group term insurance that she got from her employer to cover the bills for the family itself. It was a very minimal amount that the surviving spouse got. From there, they were able to use at least some of the money to help pay for the funeral and the celebration of life right there, to give her the best kind of farewell right there. However, with some of the things that was left over, think of like the debts, the student loan debt, any medical debt, any personal debt, think of like credit cards, loans right there. That was actually passed down to the surviving spouse. Now from there, we had to actually help liquidate any of the retirement accounts that she kind of built up for her own retirement to help pay off all those balances. One thing I forgot to mention in regards to the first situation, they were actually able to clear off everything, the mortgage, any personal loans, anything like that, car loans as well. So they're able to live debt-free. The surviving spouse in the first scenario was able to live debt-free going into her own retirement. Now on the flip side with this individual right here, their surviving spouse that is, there's problems in regards to the personal debt, everything like that, not having enough to pay off everything. What this has done for the family, that is, it now has delayed his own retirement. We calculate that he has to work another, 5-10 years more?
Yeah.
Just to be able to retire and not leaving anything for the rest of the family members, like the surviving spouse or the daughter, to kind of live off of right there. So it takes a strain on the family's finances. And this is kind of the reason why we have to look at life insurance as a protection for the family itself, and kind of hopefully that shows the importance of life insurance right there. So to kind of go on now in regards to the agenda, it kind of gets you wondering, how much life insurance do you need? Now, of course, I do want to preface that not everyone needs life insurance. It's really a need basis depending on your certain situation. Everyone's different at the end of the day. But if you determine that you need life insurance, the first method to kind of calculate how much life insurance you need is actually going to be the income replacement method. This is going to be great for spouses or single parents, anything like that, that want to help replace income for their family. First off question.
Why would you not need life insurance?
Great question. So one reason maybe that pops up in my head is that if the family has enough assets in regards to investments, real estate, stocks, bonds, whatever, they may not need life insurance because that's an extra cost to them right there. They already have enough in their bank accounts, everything like that, that if in the case something happens to them, all their worries are already kind of settled with the debts because it's already paid off, or the mortgage, anything like that. They have enough to kind of retire or pay off everything right there. But that's a great question. Why people may not need life insurance.
I would also say if you have no dependents and you have enough in your bank or your investments to pay for any funeral or final expenses, so as long as that's covered, I feel like everybody has that need. If you have no one else dependent on your income, you might not need life insurance. We'll talk about it more, but another thing to consider is you might not need life insurance right now, but your life changes over time. So sometimes you might want to get ahead of things and get life insurance while you're at your youngest current point and your healthiest current point in anticipation of needing life insurance later down the road. So like for example, I got my first life insurance policy several years ago, even before I was married, before I had a daughter, kind of in anticipation that those things might happen later down the road, but I was able to lock in good insurance rates from my early 20s that I am able to carry on into now. So sometimes it might not be a matter of needing it at the moment, but anticipating that you might need it in the future.
Yeah, great. Thank you, Alex. So yes, in regards to the income replacement method right here, there are going to be two factors that we're going to help calculate how much life insurance an individual needs. First one, in regards to the number of years, essentially how many years do you want to replace income? These are just some average figures right here. This is, of course, 5, 10, 20, 30, 40 years. Now, it really depends on an individual. Maybe they want 15 years, which is not shown right here, or maybe 26 years. It can be different for everyone, but we're just going to go over some basic numbers. The next thing we're going to be looking at is actually how much income per year do you want to replace? And we're going to be looking at after-tax figures right here, because everyone in their working career is going to be earning gross income, but what's really important is going to be the after-tax income. How much are you actually living off of right there? So in these figures, we're looking at $50,000, $100,000, $250,000, and $500,000. Now, easy just looking at the table, looking at how many years you want to replace, as well as how much income you want per year to be passed down, we can see, for example, for 5 years for $50,000, a base need of life insurance is going to be $250,000. Now, on the higher end, if we look at 40 years that you want to replace income for, as well as just say $500,000 per year, which is a hefty kind of salary right there, is going to be $20 million, of course. Looking at that, kind of daunting, but that's where Alex and I come into place and see how much do you really need at the end of the day? Because like I said, everyone's different. 40 years may not be sufficient. It could be maybe 50 years. Who knows? Right there.
And one note about using the after-tax number, when we're talking about life insurance, the death benefit that life insurance pays out is 100% tax-free. So that's why we're comparing it to your after-tax income, right? Because the money that you get from the life insurance policy will be after taxes as well.
So that's the first method. Second method is actually going to be the needs-based approach, where we're going to be factoring in a lot more things compared to the first option, where it's just the number of years as well as how much money per year. In the needs-based approach, we're looking at things such as final expenses. So this is going to be the burial costs. On average, they usually tend to be around $20,000 on the low end, national average right there. But of course, it can go higher depending on how much you want to spend and how much you want to celebrate that individual's life, that loved one's life right there. It can go from $20,000, $50,000, even upwards to $100,000, something to keep in mind. The next one we're going over is going to actually be mortgage and rent. So for an individual family who may have a mortgage, in Southern California, it's not cheap over here. We're looking at $500,000 easily right there. So if you live in a house where you want to make sure that the surviving loved ones don't have to worry about the mortgage itself, maybe you want to have enough to pay the mortgage if anything were to happen to you. In regards to rent, average rent is around $1,500, to upwards of $2,000, $3,000 of rent. If you want to make sure your loved ones can stay in their own apartment or own house for a number of years, you just got to look at how much you need per year and multiply that by the actual annual cost of the rent itself. Next one, debt. This is going to be a more general topic, but debt includes personal debt. So think of your credit cards, your loans, personal loans, school loans, anything like that. Keep in mind, just for example, student loans. On the federal side, those are not passed down to the beneficiaries, but if you have any private loans, those actually get passed down to beneficiaries, and they're kind of on the hook for paying that off as well. Next one up, childcare. This is an important one for young parents, Alex, just like yourself. You want to make sure if anything were to happen, there's money to help raise a child. And of course, the cost of childcare, not even on the daycare side, but just raising a child to up to age 18 is getting more expensive by the year itself. I think averages around $233 some thousand, upwards to $500,000 just to raise a child from birth to age 18 right there. And that, as we get older, that cost just gets more and more and more. So maybe you have to factor that in to see how much life insurance an individual needs. And the last one, college education right here. Some parents want to make sure their kids have a great education. This is selling itself getting more expensive. Rises even faster than inflation itself. I think what the national average for like a private university is around $40,000 per year. So multiply that by how many years your child's going to go to college for, that's a sizable amount right there. So if you add everything up, it's going to be well worth, 7 figures right there. If you want to make sure you pass everything down efficiently, as well as make sure all these needs are met at the end of the day. But like I said prior, not all these things affect everyone. So you maybe want to sit down with Alex and I to kind of figure out what numbers are appropriate for you. Now, we're going to be going over the 2 types of life insurance. First one is going to be term insurance. Essentially, you're only paying the premiums for life insurance policy for a set number of years. Very similar to the income replacement method. How many years do you want to pay? Could be 5, 10, 20, 30. I've seen term policies go up to 40 years right there. We can really help customize that for you and show you out there what you need.
Real quick on term, another common type of term is what's called group term. We already discussed it earlier, but that's usually the insurance that you have through work. Just note that that doesn't have a certain time period. It's not a 5-year, 10-year, 20-year policy or anything like that. It's while employed. So as long as you're employed, and if you were to pass away during that time, your group term life insurance policy would pay out. But if you have life insurance through work, it's most likely of the term variety.
Mm-hmm.
Yeah.
And kind of going off of that as well, in regards to term, it's only there for a certain amount of time. It's not going to kind of go on for the rest of your life. That's where permanent insurance comes into place. So term insurance, you're only paying for the allotted number of years right there. Now, in regards to permanent insurance, or what they call cash value insurance, these are types of policies that last the rest of your life. From day one to the day you pass away, because everyone's going to pass away. We don't know when, but it's going to be there. That time's going to be there. But it's going to last the rest of your life. Now, why they call it cash value insurance? While you're paying the premiums inside, a portion of the premiums go into the cash value bucket. Essentially, you're building equity inside your own policy right here. So another way I like to kind of show term versus permanent insurance is thinking about renting versus owning. In regards to term, it's renting. It's like you rent a car, you lease a car, or you rent an apartment, you rent a house for X amount of years, everything like that. By the time the lease is up or you're done, you don't have to pay anymore. Clean, nothing left over right there. In regards to owning it, think about owning a car, owning a house. You get to build equity inside of it. You actually own the policy itself. And then from there, it can be passed down right there. Makes it a little more simple. Now, we'll go over some advantages and disadvantages of each one. So for the first one, term insurance, one advantage, and this is the big one that everyone likes, is that the initial premiums are very low. Like I said, you're only paying for a number of years. You're not paying for the rest of your life right there. So the insurance companies are able to average the numbers out to make sure that it's cost effective to you and make sure if anything happens to you, they're able to pay out the death benefit to your beneficiaries. The second advantage is actually going to be that it's ideal for short-term needs. So one example I like to kind of put this is actually in regards to having a child. And Alex, you know, I know you've done this yourself also. You got yourself a term life insurance policy to make sure if anything happens for the next 30 years, that your daughter is going to be kind of taken care of right there. From there, once she's already 30 and plus years old, she's already a self-sufficient adult right there. She's already making her own income. She doesn't need anything else from dad right here. Now, the last one is that the advantage is that most plans can be renewed right here. What I mean by this is that at the end of the allotted term period, you're actually able to renew into a whole new policy and get another set number of years after that as well. Now, on the top of that, there's a disadvantage to that as well. And we're going to be actually going over right here that the premiums will increase over time. What that means is that the life insurance company is going to reassess your age, your health, and then from there, issue a new premium amount that you will have to pay right there. And in regards to life insurance, as we get older, there's a lot more health complications. You know, the time that's coming for you to pass away is getting smaller and smaller and smaller. The life insurance companies know that, so they're going to be increasing that premium to make sure they pay out the death benefit. Question?
So for lack of better words, the ideal payout for life insurance is when a very healthy person who is older dies of like a car accident, where it's like they had very healthy tests, so there wasn't a super high premium, and their death was not health related. Like, is that how the algorithm works, kind of?
That's correct. And I've actually heard it put once that term insurance is kind of like a really aggressive investment because you're just paying a little bit towards it. It probably will not pay out, but if it does, you'll get a heck of a return on your money, right? But the reason that the premium is low is because the insurance companies know that, say, over the next 10 years or over the next 20 years, if you're a healthy individual, you're probably not going to pass away. So they factor that into the cost as well. Yeah.
Great question. And one of the other disadvantages right here is that there's no benefit payout if you outlive the policy. It's a very cut and dry policy. You only pay for 5 years, you just pay for 5 years, you get nothing back right there. But you just protect yourself for that number of years. And the last one is that it does not build cash value. Like I said, cash value is kind of the equity portion inside of the permanent life insurance policies. You don't get to actually build that in here. Now, going over to the cash value life insurance or the permanent policy itself, the benefit right here is that you build value over time. From there, you get to actually invest that money, whether that be through a fixed interest rate, through an index, or through sub-accounts inside. You actually get to help manage how much growth you want inside your own policy. Another advantage is that premium payments will not increase. At the time of you applying for these permanent life insurance policies, the life insurance companies are going to aggregate all the amount of premiums that you need to pay for the specific death benefit amount that you want and average that out for the rest of your life. So you only get to pay one individual payment every single month for the rest of your life, and it will not increase nor decrease right there. So that helps you kind of budget how much insurance you need and how much it actually can affect your own day-to-day life right there. Now, in regards to another advantage is that there's single premium options. Now, Alex and I, we've seen other individuals who may want to not worry about the monthly premiums. Hey, we have a set amount of dollars that we just want to dump into a single premium life insurance policy. They can do that. Hey, I just had inheritance. Oh, I just got a raise from work, or I had a bonus. I want to put that towards a life insurance policy. They can do $5,000, $10,000, $20,000 into one policy and make sure it can last the rest of your life right there. It's more of the complex kind of options, but it is out there for individuals to take advantage of. Next advantage is that there is tax-deferred growth. In regards to the cash value that builds up into the policy itself, the premiums you pay are all after-tax money because you're already being paid tax from work or pensions, everything like that. You pay taxes. It goes into a life insurance policy. Now, with life insurance policy, it can actually grow. The cash value can grow. Tax-deferred. You're not paying any taxes on the growth inside. Compared to an individual like brokerage account that you're investing in, stocks, bonds, ETFs inside, when you buy and sell out of it, it causes a taxable event where the IRS is going to come after you and say, hey, you may have to owe us money at the end of the day. In these types of scenarios, you're not going to find any tax consequences until you take out the money or until it's actually distributed, maybe to the beneficiaries itself. And the last thing, now this is one of the more kind of intricate parts of permanent policies, is that there is a potential to use some of the cash value inside for tax-free income. Special case scenarios, but there's individuals out there who maybe overfund their insurance policies for their cash value to grow and be able to take out money up to a certain limit tax-free. And then from there, if anything happens to them, the loved ones don't get any of that. They just get the death benefit right there. Yes?
Why not just invest in a fund or stocks versus, life insurance?
Yeah.
So, I mean, I'd say like a couple reasons. One, if you think you need permanent life insurance, if you say it's going to cost you $100 per month, if you put that towards a permanent life insurance policy, if you happen to pass away anytime soon, your beneficiaries are going to get $100,000, right? If instead you're putting that $100 per month towards an investment, it's going to take you, 10, 20, 30 years to get to that $100,000 amount. So it's kind of adding a protection layer, kind of like while you're building your savings. Another part of it is, like Brandon mentioned, the tax deferred growth. If you're just investing, say, in a brokerage investment account, you've bought some stocks, you've bought some mutual funds, those are going to grow, and they might even grow faster than the life insurance policy, but you're going to have to pay capital gains taxes on all of your growth as well. Another kind of reason, just to throw out there, this is one that is important for someone with like young kids. If you have money inside of cash value, it actually doesn't show up on your balance sheet if you're applying for financial aid for colleges or anything like that. Whereas like a 529 college savings plan or your own personal investments would show up on your balance sheet and might make it harder to qualify for something like that. So there's a few reasons. I feel like in a perfect plan, you're doing both. Yeah.
Oh, great question. And the one big disadvantage right here in regards to permanent policies are going to be the higher premiums. Because keep in mind, like I said, the life insurance company is going to be paying the death benefit out guaranteed as long as you hold the policy for the rest of your life, because death is inevitable and they need to make sure that they have enough in their own bank accounts to pay out that tax-free death benefit to your loved ones at the end of the day. Okay. And one thing I do want to go over before we...
Want to go to this one next?
Yes, I'll actually go right there. Before we go over to the additional benefits, we have some examples right here of sample quotes for life insurance policies. This is going to be for a 55-year-old female at standard health ratings right here. So in this example, we're going to be looking at 10-year term, 20-year term, 30-year term, and then a permanent policy utilizing a variable universal life right here. So they're all going to be for $200,000 in death benefit. Like I said, for that 55-year-old, there's a 10-year term that's going to last until 65 years old. The premium payments for that is only going to be $47.47 right here. The chances of a 55-year-old passing away at standard health in the next 10 years, very low. So that's how they're able to calculate a very low premium payment right there. Now, as the person gets older, you're looking at the 20-year term and 30-year term, the premium payments have now increased $63.41 per month, upwards to $137.47 per month, because the chances of that person passing away are now exponentially higher. Because in this case, they're 75 years old and 85 years old. National average, women tend to live 80 plus years right there. Compared to us men, we only live up to age 77, roughly, right there. So for them to calculate how much, or what essentially calculate to kind of a percentage of the chances of an individual dying, they're able to calculate a specific dollar amount to put towards that right there.
And one note off of that is that life insurance for females is actually cheaper than the male counterparts because they have a longer life expectancy. So from the life insurance company's perspective, if a female is applying, they're less likely to pass away during the 10, 20, or 30-year term, so it's a lower premium.
Mm-hmm. Yeah, thank you. And then the last thing I do want to go over is the permanent policy. The striking thing right here is that you see the premium payments have now jumped up to $270.42 inside. That's essentially nearly double of the 30-year because they're taking into consideration the life expectancy of an actual woman that can go a long ways right there. And if the individual pays the premium every single month for the rest of their life, and the day they pass away, they are guaranteed, the loved ones are guaranteed that $200,000. They need to make sure that they have enough money in their own bank account to pay that death benefit out right there. Now, at the same time, like I said, when you have a permanent policy, you own the policy itself. You actually get to build equity. And you actually get to see estimated cash value throughout the years. So if an individual, the 55-year-old, were to actually start this policy and invest in it at a moderate growth rate right there inside the cash value, the portions of their premium payments go into the cash value and now has grown at age 75 upwards to $67,000. Now wait 10 more years, premium payments are still being paid at the end of the day, that cash value is still growing in just say in the market, an index, anything like that. This individual will have almost $119,000 in cash value, either to use for any emergency or to even pass down to the loved ones right there.
Just one more note on the cash value. So let's say you want to access this cash value, when you're 75 or in this case 85 years old. There's 3 ways that you can access your cash value. One is to do a full surrender, and that's basically saying, hey, thanks for doing business, Pacific Life. I don't need this life insurance policy anymore. Can I get my cash value, right? And so basically you get rid of the life insurance policy at age 85. This person would take home $118,000. So an example of that would be, say you got a $200,000 policy because you're married and you want to make sure that if you pass away, your spouse is taken care of. But then your spouse passes away before you and you no longer have that need. You might say, I don't need this life insurance policy anymore. I'll take my $118,000 and do whatever I want with it. So that's one way, full surrender. There's also partial surrender. This would be saying, I would like access to some of my cash value. Maybe I'll take half of my $118,000, right? And so you would basically be able to take out half of your cash value, but your death benefit would be cut in half as well. So you might bring your death benefit down to $100,000 and take home, $60,000 or so to do whatever you want with. And then the third way is a tax-free loan, right? And so this is basically taking a loan out against yourself, right? And so as far as loans go, it's better than taking a loan out from a bank or anything like that because you're taking the loan out from yourself. And it's tax-free as well. A lot of strategies actually involve taking a loan out and not paying it back. We would never necessarily recommend doing that, but really the only consequence, let's say I took out a $10,000 loan on my $118,000 of cash value and I never paid it back and I passed away, they would take the $10,000 that I owe from the death benefit that goes to my, my beneficiaries. So sometimes, Brandon talked about it earlier about the tax-free income. Sometimes people will use permanent life insurance policy to help plan for retirement, and they'll just take out a bunch of tax-free loans from it to use to fund their retirement, and they don't really care as much about what goes to the next generation. So let me know if you want to talk more about one of those types of strategies. But,
yes,
but yeah.
Awesome. And before we go to long-term care, the last thing I do want to go over in regards to life insurance is going to be the additional benefits, or what they call riders. Now, not all policies are going to have riders. These actually do come at a cost that's tacked on to the monthly premium right there if you want certain benefits. Now, the more popular benefits out there in the world of life insurance are going to be waiver of premium, which is going to be essentially if you are, just say, terminally ill. At that point, the life insurance company may say, hey, no worries, don't pay the life insurance premiums itself. We'll let you kind of slide on by up until that day that you pass. But you're still able to keep the coverage that you need and pass down the benefits to the loved ones itself. Now, the second rider that's popular out there is actually accelerated death benefit right here. So same kind of example, terminally ill individual, they're paying the premiums up until a certain point, but the medical cost, for the last 6 months of their life is going to be exponentially high. they're in the hospital every single day, anything like that. So these life insurance companies allow the individuals, the insured individuals, to actually take out their death benefit, not pass it along to their loved ones, but take it out to help pay for all those costs of the hospital bills, anything like that. Just essentially accelerates that, and nothing's left passed down to the loved ones at the end of the day. The third benefit right here is accidental death. Essentially, if you say you're in a car accident, a bus accident, a boating accident, airplanes, I know that's been on the news recently with all the airplanes crashing, but if in those wild case scenarios, there is an accidental death benefit that may have the life insurance company pay out a certain amount more in those rare instances right there. It could be a set dollar amount, or it could be a multiple of the death benefit itself, maybe like 1 extra or 2 extra times the death benefit itself. Now, the last one right here, which is a new rider out in the industry itself, is actually going to be long-term care riders that help essentially accelerate the death benefit to pay out on a monthly basis for any long-term care needs, whether that be assisted living facilities, at-home care, or actually full-on long-term care facilities. These policies allow the individual to accelerate the death benefit, $100,000, $200,000, break that up to the monthly payments, and then pay those costs that are actually increasing by the day itself. And to learn more about long-term care, I'm actually going to pass it along to Alex.
Thank you. Cool. Thanks, Brandon. Okay, so switching gears. So we were talking about life insurance. That's obviously a benefit that pays out if you pass away. Another huge need is long-term care insurance. And I'd say this right now is an even kind of like hotter topic in the financial services industry because long-term care is so expensive. So we'll talk about the cost in a second. But first of all, why might you need long-term care? So one is to be able to afford high quality care if you do end up needing it. So we hear a lot, oh, I have Medicare, that will pay for my long-term care. That's not the case. Medicare will pay for the first 20 days of long-term care, and then they'll pay a portion of the next 80 days. So that's only 100 days that they'll be helping with long-term care. Any stay longer than that, Medicare does not cover. So kind of a common misconception that Medicare will cover long-term care. There's also Medi-Cal, which is the California version of Medicaid, which is essentially the welfare benefit. Medi-Cal will pay for long-term care services, but you have to qualify for Medi-Cal. And the way that you qualify for Medi-Cal is you have to have income under a certain level and you have to have assets under a certain level. So you might have to spend all of your investments, even potentially sell your home before qualifying for Medi-Cal. If you do qualify for Medi-Cal, you might get long-term care covered, but you're not going to have, the pick of all of the finest facilities. You're going to be stuck with whichever ones will actually take Medi-Cal, which from my experience aren't the nicest ones. I'm sure there's some that are fine, but not as nice as the ones that take private money there. So to be able to afford high quality care, avoid burdening your kids. So this is actually the most common kind of discussion that we have with our clients is, my parent is right now needing long-term care and it's a hassle. It's costing me a lot of money, it's costing me a lot of time, etc. And also a lot of clients that I talk to about long-term care saying, hey, do you have a long-term care plan? And you'd be surprised about how often I get an answer is like, yeah, I have my kids. So for some people that is their long-term care plan. And I'd say that's fine. Just make sure that you've talked to your kids about this and they accept this potential burden. If your kid is in the medical industry or something like that, they could be very well equipped to take care of you in those times of need, but you don't want to spring it on them, as a surprise. So it is really to make sure that your plan is set up so that you're not slowing down the progress and the financial journey of your own, kids in the process. And then another big one is to leave more for your loved ones by protecting your assets. So by having long-term care insurance, money that will pay out if you need long-term care, that's less money that you have to take out from your other investment accounts, your bank accounts, etc. So you're preserving your assets, maybe your home equity as well. You're preserving your assets to get passed down to the next generation because your long-term care is paid for. If you don't have long-term care, you might have to liquidate your investments, liquidate your home to pay for those services, and that's money that won't be passing down to the next generation. So if your goal is to continue building generational wealth, long-term care is a good defense to make sure that that continues to happen, even if you have a lot of medical expenses later in life. How much does long-term care cost? So there's some estimates on how much different forms of long-term care might cost. So focus your area on this small box here. So the first type of long-term care is home care. So this allows an individual or a couple to remain at their home, and a professional caretaker or family member comes to the home for a certain length of time each day to provide care, right? So if you have somebody coming 8 hours per day for home care, the estimate in the Los Angeles area is going to be about $80,000 per year, which comes out to about $6,700 per month. And these are averages, right? So if you want a high quality of care, it might be more than that amount. If you're looking for deals, you might be able to get under that amount there, but that is home care. The next one is assisted living. This is essentially kind of in between a full nursing home and home care. So assisted living facilities offer less medical care than a nursing home and emphasize the resident's independence. So the average cost of an assisted living facility in this case is about $54,000, which I believe comes out to about $4,500 per month there. And then the last one, and this is really the big one when you think about long-term care, the most expensive one is going to be a full-service nursing home. So highest level of medical care and personal assistance. So basically somebody's always on the clock watching you, you have your own space, you live there full-time. And the average cost in this area is about $109,000, which, what does that come out to? About $10,000, a little under $10,000 per month there. I was actually just visiting my great aunt in Stockton, California, which is up north, a little bit lower cost of living area here. She was in a nice nursing home, $14,000 per month were her costs, right? So it's very expensive, and you could do a great job planning for retirement. I'm going to retire, my income goal is $10,000 per month, and my retirement plan looks great. But if all of a sudden it jumps up to $15,000, $16,000, $17,000 per month because you need long-term care, will your retirement plan be able to survive that, or are you going to have to start spending all of your assets there? So long-term care, very expensive. And then another note here is that the cost of long-term care is actually going up faster than inflation. Because like Brandon mentioned, on average, the population is aging. Generations like baby boomers, et cetera, aren't too far from needing long-term care themselves. And so demand is just crazy high for long-term care. There's lots of issues in zoning and building, not enough long-term care facilities being built. So, high demand, low supply leads to really quickly rising costs for long-term care there. Pasadena has a ton of great long-term care facilities, but I'd say they're probably all above what this average number is here. So that's the need, right? Okay, so if you've decided you need long-term care, and you start to look at different long-term care insurance policies, these are the different factors that are going to go into kind of like creating your long-term care policy. So the first one on there is the monthly maximum. So this is how much per month your long-term care policy will pay out if you end up needing long-term care. So those can go anywhere from $2,000, they can go upwards of $10,000, all the way up to $15,000, $16,000 per month. The lower your monthly maximum, the cheaper your policy is going to be. The higher your monthly maximum, the more expensive your policy is going to be. So usually it's a matter of looking at what are your other income sources. Do you have a pension? You have Social Security? How much other investment assets? Anything that's not going to cover, you might want to consider getting as far as long-term care insurance. Second one is the benefit period. So it's how long will that monthly maximum last, right? So that could be 1 year all the way up to 6 years. So how long will you be able to keep taking out that monthly maximum? Obviously, the shorter the time period, the cheaper your policy. The more expensive the time period, the more expensive your policy is going to be. The average length of a stay in a nursing home is give or take around 2 years. To be honest, nursing home is usually going to be your last stop, right? You're not going to be living there forever. But I'd say you'd want to be prepared for potential 2-year stay inside of a nursing home there. Elimination period. This is kind of like your deductible when it comes to a long-term care insurance policy. It's how long you have to pay out of pocket before your policy kicks in, right? So it can be anywhere from 0 days to a whole year. The most common one that we see is a 90-day elimination period. So if you have a 90-day elimination period, that means you would have to pay for the first 3 months of long-term care services on your own, and then your policy kicks in and you'll get the monthly maximum for whatever benefit period that you have. If you're looking for ways to cut costs on your long-term care insurance, you can increase that elimination period all the way up to a year. I pay for the first year, and then the long-term care insurance policy pays out after that. If you don't like the idea of paying anything out of pocket, you can bring that elimination period down to 0, but the cost of your premium for the long-term care policy is going to go up if you decide to do that. Fourth one is inflation protection, right? So this is how fast your monthly maximum will grow each year, right? So if you have a 0% inflation protection, say you have a $5,000 monthly maximum, say I'm a 55-year-old female today and I need the insurance policy when I'm 85, that's 30 years from now. $5,000 per month today is a lot more valuable than $5,000 per month is going to be in 30 years, right? So you can cut costs on a long-term care policy by having little to no inflation protection, but it's risky. If you don't need it for a long time, you're not sure if the monthly maximum that you've locked in is going to be sufficient later down the road, right? So different policies will have inflation protection built in. Long-term average of inflation is about 2% per year. So if you're looking to just keep up with inflation, you might want to make sure that your policy has a 2% inflation protection. I mentioned earlier that long-term care costs are going up faster than inflation, so you might want to look into 3%, 4% inflation protection, just to make sure that your policy's value is growing along with the price of the long-term care itself. The more inflation protection you have, the more costly it's going to be. The next one is indemnity or reimbursement. So every type of long-term care policy is going to be one or the other, or maybe a mix of both. I'll start with reimbursement. That's exactly how it sounds. You basically get the receipts of your long-term care treatment, you send them to the insurance company, and they reimburse you for your long-term care costs, right? And so it's great, it will pay out, but it's a little bit more work on you and your family to produce those receipts. And you're not going to be able to get away with, paying a family member who's not a professional or anything like that, because you need to have official receipts to show to get reimbursed from the insurance company. The second type is indemnity. Indemnity basically means that if you need long-term care, and basically that means you have to be disabled, means you can't perform 2 of the 6 activities of daily living. If you need that, the policy will start paying out up to its limits, assuming you've met that elimination period, and you don't have to produce receipts or anything like that. So we typically prefer an indemnity style policy just because it gives you more flexibility later in life to use that money from the policy as you see fit, right? You don't necessarily have to produce an official receipt. So if you're looking to bring a family member in to help with your long-term care, this might be the way to make sure that they're compensated for that. In addition, if you're looking to cut costs on long-term care treatment, you can hire, I'd say, less official services out there, right? And you might still be able to pay for them with an indemnity policy where you might have difficulty with a reimbursement policy there. I'd say typically indemnity is going to be slightly more expensive, but it's really more insurance company by insurance company. Some do the reimbursement style, some do the indemnity style. Types of insurance. So we mentioned with life insurance, there was term and permanent. With long-term care, there's 2 primary types. There's traditional long-term care insurance, and then there's hybrid insurance. Traditional long-term care insurance is, like it sounds, just long-term care insurance. has all of those different factors that we looked at earlier. If you happen to need long-term care, your policy will pay out. Hybrid insurance is actually a mix of permanent life insurance and long-term care insurance. And this has been gaining a lot of popularity over the years. Almost all of the major life insurance companies are offering these type of hybrid insurance because they know long-term care is such a big problem, such a big need. I'll go through the benefits, but one of the big ones, and you can kind of just see it in your head, is the fact that it's life insurance and long-term care insurance means that you're going to get a benefit even if you don't end up needing the long-term care insurance. And that's one of the biggest downsides to the traditional long-term care insurance, is it is very much a use it or lose it type of insurance. Because if you pass away and you never end up needing long-term care, you don't end up having anything to show for that money that you've put into the long-term care policy. So I'll go quickly through advantages and disadvantages of traditional long-term care. So advantages, typically will have a lower premium, right? And this makes sense, right? Because it's only doing one thing, right? It's only going to pay out if you need long-term care insurance. I'd say sometimes, I've run the numbers for many clients, and sometimes, surprisingly, the hybrid insurance will be as cost-effective or more cost-effective than long-term care. Advantage, underwriting for long-term care risk only. This is an advantage because it means they're going to be, depending on your health issues, potentially a little bit more lenient in being able to qualify, right? Because they're looking at you as a risk of needing long-term care, as opposed to a life insurance policy, they're looking at the risk of you passing away. So certain ailments might really hinder your ability to get life insurance. So things like, heart issues, things like that, history of cancer, these types of things might hinder your ability to get life insurance, but they might not hurt your ability to get long-term care insurance, because in the issue of a heart issue, heart attack is a risk. If you have a heart attack, you might pass away, but that's not probably going to make you in need of a long-term care or like a nursing home or anything like that. So they're looking for different things, and typically it's a little bit easier to qualify. Inflation protection, almost every traditional long-term care insurer will offer some inflation protection. With the hybrid policies, some will not offer inflation protection. So that's a big advantage for traditional long-term care as well. Disadvantages, I'm going to skip to that second one, use it or lose it. This is the one I already mentioned. It's for long-term care only. If you pass away, you never end up needing long-term care. You spent the money, you got the peace of mind, but you don't have really any tangible benefit to show for it. Another big one, premiums can increase. So this is a weird one. With life insurance policies, like permanent policies, like Brandon mentioned earlier, you have a set premium, you pay for it for the rest of your life. It's not going to unexpectedly jump on you. But with long-term care, the insurance company actually reserves the right to raise the prices for everybody. Now, to do this, they have to get approval from California's state insurance department, but they have done this before. So big part of this is long-term care is a little bit newer than life insurance, and so when they first started creating these products, they were underpricing them, and then too many people were needing long-term care, and the insurance companies were paying out too much. So in order to stay alive as insurance companies, they had to raise the premium for everybody. And yeah, so it's a downside. I usually say when somebody gets a traditional long-term care policy to expect one price increase, about 20% price increase sometime during your lifetime. Hopefully it never happens, but historically, if you look at, you can see a history of price increases. Typically, there's going to be one every 20 or 30 years that will get approved and cause your premiums to increase. So kind of a heads up there. I think a lot of people don't know that. And then does not build cash value. There's no investment component. If you decide you don't need your long-term care policy in 20 years, you can't surrender it and get your cash value out of it like you could a permanent life insurance policy. So that's traditional long-term care insurance. And then hybrid insurance. So like I mentioned, this is the mix of life insurance and long-term care insurance. Advantages, there's a death benefit if you pass away without needing long-term care. So if you pass away quickly, you don't end up needing a long-term care insurance, at least your loved ones will get a death benefit, so some sort of value for the money that you've put inside of the policy. Another one is cash value accumulation. Because it is a permanent life insurance policy, it will build up that equity, that cash value that will grow for you over time. So if you decide in 30 years, oh, I inherited $1 million, I don't need this long-term care insurance policy anymore, you could surrender it, get your cash value out. You could take tax-free loans out on it for emergencies. You have options for cash value there. And then kind of the big one is there's just benefits in multiple scenarios, whether you do need long-term care or you don't need long-term care, or you decide you don't need the policy anymore, you're going to get some sort of benefit from the hybrid policy here. Disadvantages, typically higher premium, makes sense, doing two things, right? You might get a better deal on each one than going individual life insurance and individual long-term care, but as opposed to just long-term care on its own, typically going to have a higher premium. And then a little bit more difficult to qualify for because you need to be underwritten for your life risk and your long-term care risk, right? So, all the different type of ailments could impact your ability to qualify for hybrid insurance. They're checking for both risks there. So that's the disadvantages. Going to go through some sample quotes here. So this is the best I could do to get kind of an apples to apples comparison of traditional long-term care in the middle here, and then a hybrid policy here on the right. So the traditional long-term care, this is a quote from Mutual of Omaha. This is also for a 55-year-old female with standard health ratings. Let's say they want a monthly maximum of $8,000 per month for 2 years. They got a 90-day elimination period, 0% inflation protection. So one note is I put 0% inflation protection so we could compare the hybrid to the long-term care. The long-term care with Mutual of Omaha does have inflation protection options. So you could add in 3% inflation protection, 5% inflation protection. However, that is going to cause your premium to go up a little bit. But just for comparative purposes, I have 0% inflation protection on both of these because with the hybrid insurance policy, in this case, we cannot add on inflation protection. With the traditional long-term care, there is no death benefit, right? So if you pass away, that's it. Premium on that is $194.88. Estimated cash value at 75 and age 85 is going to be zero because there's no cash value. And then indemnity versus reimbursement. So with Mutual of Omaha, they have basically you're able to get 25%. In this case, it'd be $2,000 indemnity style. No questions asked. It's a cash benefit. You can use it for whatever. Anything above that 25%, or in this case $2,000, you have to submit receipts. It's a reimbursement style policy. On the right side is a Pacific Life life insurance policy with a long-term care rider. It's actually that same permanent policy that Brandon showed you, but with a long-term care rider. And I'm actually just really quickly toggle back there so you can kind of see the cost difference. So you can see without the long-term care rider, this policy was $270 per month. And then with the long-term care rider, we're up to $302 per month. So it gives you an idea of like how much adding on that long-term care rider costs you on a monthly level. Also, $8,000 monthly maximum, pays out for about 2 years, 90-day elimination period, 0% inflation protection, death benefit now of $200,000. So that's a big difference as compared to the traditional long-term care is if you pass away, now your loved one is getting $200,000 tax-free for the money that you've spent in the policy. Now, you pay for that additional benefit, so the premium there is at $302 per month. But this one also does have the cash value component, about $66,000 at age 75, at age 85, about $117,000. And this one is an indemnity style policy. So you are disabled, this policy will start paying out after you meet your 90-day elimination period. So again, these are just kind of sample quotes, so you can just kind of get a ballpark of what prices look like and things like that. Obviously, your age is going to impact the quote. Your health, so these are standard health ratings. It's the most common health rating that people get. You can get rated better than standard. You can get rated worse than standard, which does impact the numbers. And it's really, on this one especially, really got to look at some of these inflation protection options as well. So Brandon and I, Cetera Investors, independent company, so we don't work for a life insurance company, but we can help pair you with the life insurance and long-term care company that might make the most sense for you. So we can run quotes with a variety of different firms out there to see what might make the most sense. But yeah, so that's some sample quotes there. Big question we get is, when should I consider long-term care insurance? So one, I'd say sooner than you think. This is the most common scenario. So typically we'll have a client, say maybe they're around 60s, early 60s. They have a parent that's in their late 80s, early 90s that needs long-term care. And they see firsthand how expensive, how much of a headache that can be. And so then they call me and they say, oh, maybe I should get my own long-term care policy. Now sometimes it might make sense, but oftentimes if you're already mid to late 60s, it's going to be so cost prohibitive to get a long-term care policy. I'd say really the sweet spot is in your 50s. Not if you're above that, there might still be time. If you're below that, it still might make sense. But that's kind of that sweet spot of if you're going to add on long-term care insurance, for it to still be somewhat affordable, think of like another car payment, kind of like in that range. You're looking at your 50s. If you're waiting until your late 60s and 70s, that's an expensive car payment. And then if you're really young, 20s, 30s, might not make sense to add that monthly cost for something you're not going to need until you're in your 80s most likely. So for traditional long-term care, I say 50s. Now for a hybrid insurance policy, it's going to be whenever you need life insurance is a good time to add that on. So for example, if somebody who has a young family, they're applying for life insurance, they can just throw on that long-term care rider, and it might only be an additional $20, $30 per month on top of their premium. And so they're covered, and they got it when they needed life insurance, which was at a younger age, but they're making it so that they won't have to apply for any traditional long-term care insurance when they're in their mid-50s. So for hybrid insurance, I'd say it's more of like as soon as possible. Can't really be too young to tack on that cost to your permanent life insurance policy. All right, a couple more slides here. One is just want to go through the application process. So this is going to be kind of the same whether you're going for life insurance or long-term care insurance. So put in there that it's a 1 to 6 month process. We've had some people apply for life insurance. It gets issued, the policy starts within a month, but then we've had some that take 6 months, and it really depends on how responsive and quick you are in getting back any additional information that the life insurance company wants. Also has to do with how busy that life insurance company is. Do they have a lot of cases they're looking at? Are you in the back of like a long line of people applying? And then how many health complications, how many additional requirements is your life insurance going to have, could cause the process to take a little bit longer. So step one, you meet with your advisor, you look at some quotes, you decide which policy you want to apply for. So you finalize the policy you want to apply for. Next would be to complete and sign an application. So an application that asks you some basic health questions, asks for your social and kind of your basic information there. Once that application is signed by you, that gets sent off to the life insurance company that you're applying towards, and it goes into their underwriting department, right? Their underwriting department is basically the ones who decide who gets accepted for life insurance and what health rating they get. When you go into underwriting, they're going to check your MIB report, or the Medical Information Bureau report. This is a report that's shared by all major hospitals and all major insurance companies. That's basically a quick check to see if you have any serious health issues, right? If you've had any major diagnoses like diabetes, cancers, things of that nature, those are going to pop up right away on an MIB report. So I'd say don't lie on any insurance applications, because you would be surprised how detailed notes that they have access to just from that Medical Information Bureau report. They'll also do a medical exam typically. So they'll typically send a nurse out to your home or your work, and they'll do a blood and urine. They'll take your blood pressure. They probably take your height and weight, just to confirm that everything that you're saying on the application is correct. So this is kind of like, think about the life insurance company is sending a nurse out to kind of cover their own butts to make sure that they're not insuring somebody that is going to pass away soon, right? So they'll check all of your information. Again, another reason not to lie is because they'll actually send a nurse out to check on you. And then any follow-up requirements. So depending on your health history, you might have to answer additional questions about your treatment of diabetes. What is your most recent A1C readings, things of that nature. If you have more complex medical issues, they might need a note from your doctor, and they'll request the note from their doctor. So those extra follow-up requirements is sometimes where we see the process creep from 1 or 2 months to like 4 or 5 months. If there's a lot of those, if there's a lot of different doctors that they have to track down and ask questions of. Once they get all of this information, the MIB report, the medical exam, any follow-up requirements, the underwriting department will make their decision whether to accept you or deny you. If you get denied, that's easy. You can't get the life insurance policy. If you get accepted, they'll give you a health rating. So most likely you'll get a standard health rating. If you have really good health, you might get preferred or preferred plus health ratings. If you are below standard health, you might get what we call rated, which is basically, means your premium will go up, right? Now when they give you an offer back, you don't have to take it. So say you applied, I was hoping to get standard policies, I got rated, and now my premium is going to be double for the same amount. It might not make financially sense for me to get it anymore. So once they offer it, you'll have that final decision. Do you want to accept the policy or not take the policy? Typically you'll accept it, and then you'll make your first premium payment, and then the policy is in force. So that's kind of a run through of the application process. I'd say that's a good reason if you do need life insurance to go through your advisor, because they'll help you with all of the logistics and that kind of stuff for you. If you do this on your own, it's complex. You can get lost in the middle of this process for sure. All right, so that's it for the meat of our presentation. I'd say next steps is really ask yourself, 1, do I need life insurance? 2, do I need long-term care insurance? And if the answer is yes and you don't have these things, set a meeting with Brandon, myself, or Tori, and we'll help pair you with the right policy, see if it makes sense. If you do already have these insurances, you would want to make sure that these insurance policies are the right ones for you. Are they ones that are going to be there when you need them? Like maybe you have term, but maybe you really should have permanent. So you want to make sure it's the right stuff. Are you overinsured? A lot of people get sold life insurance policies by a family member and they have way too much insurance. And so we'll sometimes be the people to tell you, it's like, hey, you probably have more than you need. More likely, are you underinsured? Do we need to add on additional insurance there? So on an appointment, we can help you with a life insurance needs analysis, determining how much you need, either using that income replacement method or the needs-based method. Same with long-term care insurance. One of the cool things that we can do for long-term care is we can actually look at your financial plan, and then we can stress test it. We could say, okay, your probability of success with your financial plan, it's 90%. That looks good. But what happens if from age 80 to 83, you need an additional $10,000 per month because you need long-term care? We can throw that into the analysis, and if your probability of success goes down to 0%, right? Okay, that might mean that you need long-term care. If your probability of success goes down from 90% to 89%, maybe you have enough assets on your own to cover a long-term care event. So we can stress test your plan to see if you need long-term care. Current insurance policy review. If you've had a life insurance policy for a long time, I would recommend reviewing it. The life insurance and long-term care industries have changed a lot. They've repriced several times. So even if you've had a life insurance policy for 10, 20 years, you might actually be able to essentially roll that over into a new and improved policy because of the way that things have changed over the years. So like for example, life expectancies have gone up, not in the last 2 or 3 years, but generally over the last 20 or 30 years. So because life expectancy has gone up, premiums for life insurance have actually gone down because they're less likely to have to pay out. So it's worth reviewing an old policy, even if you think you might be covered. And then obviously we can help requesting quotes from all of the different life insurance companies out there. So some final things inside of your folder. Hopefully most of you have already done this with your advisor, but if you haven't already, Asset Map is kind of the new program that we're using to help our clients see where all of their financial assets are all on one page. There is a life insurance section at the top here, so we can make sure that your insurance policies are plugged in there. Schedule a meeting with your advisor, or you can scan this code and actually start putting together your asset map if you haven't seen that already. And all right, and that concludes the meat of our presentation. Does anybody have any questions? All right.
When you go through the application
Mhm.
process, does that cost anything?
It doesn't.
Or-
It doesn't. It's just your time and effort. Yeah, because I will say, because sometimes you'll have to sign a bunch of forms, you'll have to scan them back to us, so it does take time, so you definitely don't want to do it if you're not serious about it, but it doesn't cost anything. So if you go through, you wait 5 months, you do all this stuff, and then you end up getting denied, you're not on the hook for any money. Yeah. It's kind of like an investment that the insurance company makes in order to make sure they're underwriting the right people and charging the right prices. So they cover all of the costs of like sending a nurse out and that kind of stuff. Yeah, so your time, which is valuable, but no dollar value. Yeah. Yep. Anything else? All right, cool. Well, thank you all so much for coming out tonight. Yeah.